Okay, let's go ahead and get started. First of all, welcome webinar attendees. Thank you to our partner for today's webinar, Intrinsic Residential Builders. Excuse me. Announcements: the Multifamily Builders Council annual golf tournament presented by Anderson Windows is open for golfer registration and partnerships. The tournament is set for October 14th at the courses at Waters Creek. Forms are available on the calendar at dallasbuilders.org. We are about to start our webinar, but first, just a reminder, this webinar will be recorded and posted on the Dallas BA YouTube channel and social media. We will be taking questions at the end of this program. Please put any questions you have in the Q&A. You can find the feature at the bottom of your screen. Questions will be answered at the end of the program. Without further ado, please help me welcome our keynote speaker, market analyst Dan Sindelar with RealPage. Dan?
Thank you very much for having me here. I look forward to talking about the Dallas and Fort Worth apartment market update. I have about 40 or so slides, not only on Dallas and Fort Worth, but give some kind of overall context into how those markets then fit nationally. And then in taking a look at what was presented last year, I've got about 9 or 10 slides that give some information about San Antonio, Austin, and Houston at the end. Depending on time, we can choose to go through those, or they'll obviously be in a slide deck that'll be distributed afterwards. And then I know my director, Carl Whitaker, is joining as well. He'll be keeping an eye on the chat, and it sounds like we'll wait until the end to have questions. So without further ado, I will go ahead and get started. So one of the big key themes when we take a look at 2021 performance and apartment market performance has been the migration and what that's caused in terms of demand patterns throughout the United States. So I figured I would start off with this slide here that gives kind of an overview of the U.S. And this is census data and estimated population change from July of 2020, so kind of about that early start of the pandemic, through July of 2021, so kind of the mid part of 2021, but right kind of in the bite of where we started to see that increased demand in the apartment market. And if you kind of paid attention to any of the kind of overarching headlines of where the demand is and the migration patterns, the color coding on this map and what you'll see on the left and right hand side won't be too much of a surprise. I wanted to point out a couple of things, not only that California, Illinois, and New York are always kind of in the headlines for the out-migration, which we see here and holds true within these estimates. But then also, conversely, you have Texas and Florida who have been in the news in terms of collecting, in migration and having population increase over the course of the last couple of years and even prior to the pandemic. And the other thing I wanted to point out was just the proximity of the states that are picking up that as well. So when we look at California, you still get in-migration and additional population growth in Nevada, Utah, and Arizona. Texas, you would get it from Illinois, and you even get that a little bit from New York. And then certainly on the East Coast, you're going to see the New York go into the Carolinas, Florida, and Georgia as well. So kind of wanted to use this to kind of set the table for what we're going to see in terms of the overarching demand profile. And in keeping with that, I like this scatter plot. We've used this in our national updates, and it lends itself to our discussion, certainly for DFW and kind of the Sun Belt as a whole. And so what we're looking at here is using March of 2020, so kind of the beginning of the pandemic, and looking at overall net apartment absorption through the end of 2021, so through December. And you can see DFW way over here in the right-hand corner at almost 70,000 units and right at about 9%. So just phenomenal demand for apartments and apartment renters within the DFW market throughout essentially the entire COVID pandemic, and that we're still, in early 2022. And the other thing I wanted to point out, because we will have some context into some other major Texas markets as well throughout this discussion, is you've got Houston over here picking up a large chunk at 50,000. We always hear about Austin located right here, and then San Antonio. And then the overarching Sun Belt as well. So you'll see Nashville and Charlotte, and then some of your Florida markets of Orlando and Miami, and then you get Atlanta and Georgia, and then even DC as well, picking up some demand. But kind of sets the table for the overarching discussion of the demand in the Sun Belt, and then how much of that demand that the DFW area received as well. And to kind of piggyback off of that and use a topic that was, talked about even pre-COVID and is still continued to talk about, is the Sunbelt metros and the high supply Sunbelt metros of, think of, again, DFW, Atlanta, your Florida markets, Phoenix, compared to your typical coastal gateway markets. So your LA, the Bay Area, New York, and Seattle. And prior to COVID, there was always talk of whether or not those Sunbelt metros were seeing too much supply, and whether or not the demand could keep up with that supply, and whether or not you'd still see the same performance metrics in those particular areas. And so what this chart does is show that not only did, even prior to COVID, those Sunbelt metros keep pace and even outperform the gateways, slightly, but once COVID hit, that dip was not as deep, and since then have been on a very fast trajectory upward. And so it bucks the trend that, just because you have the high supply, that the demand is going to struggle to keep pace. And what we've seen throughout COVID, and certainly in 2021, is just the appetite and the demand for apartments have kept pace with that, and led to phenomenal performance. And you can see that here in the year-over-year change in asking rents. And kind of another thing I wanted to point out, and I love using this chart, I borrowed this from our national update as well, and this is something we've been keeping an eye on, is using February of 2020 as kind of that pre-COVID level, and looking at the change in employment from the most current employment stats to February of 2020 or pre-COVID. And you can see here that you've got Dallas and Fort Worth at already above the pre-pandemic peak, so have already regained all of the jobs that were lost, plus additional jobs, so just above 2%. And then you even have Austin on this chart as well. So 3 out of the major 6 markets within Texas have already surpassed the pre-pandemic level in terms of overall jobs. So not only are you getting the migration into the Sun Belt, but you're also getting that really quick economic recovery as well. And the last couple slides here before we get into some more DFW specific is one of the other markers that we've taken a look at through RealPage. We have application software and all of our different softwares in the multifamily space. And through that, we're able to capture the renter income, not only from the application, but when those applications are turned into leases. And this is a current set of metrics, and so it's not going to be as dated as maybe some of the income metrics that you'll get from the census. And so we've really liked using this metric. And so one thing I wanted to point out here, this is the U.S. as a whole, and then the next slide we'll get to DFW. But I wanted to show that not only has the average income increased, so when we take a look at wage growth, and it's at 72,000, up 13% year over year. And a key thing to keep in mind is this trailing 12 that has continued to rise and go up. And so, the topic that you hear in the news sometimes is the rent to income ratios of apartment renters. Can they keep up with the rising rents? And in the institutional grade, apartments that we specifically track, we've definitely seen the income ratio stand at about 20%, which on average is very good. So then when we flip over to the DFW, you can see that not only has that trajectory even more of an increase, or even more accelerated than the US as a whole, But when we take a look at 73,000 average income at the end of 2021, so about 1,000 less than the U.S. average, and the first time that DFW has gone above the U.S. average, but up almost 30% year over year. And again, you see that really good spike on the trailing 12 average as well. And so when we look at all the demand profile and the demand metrics of the economic recovery, your renter income, which would be a combination of inflation and organic wage increases, and then in the case of DFW, increases due to in-migration, but then also the migration patterns. It sets the table for what we saw in terms of 2021, breaking records from a demand and performance perspective. And so kind of off of that, what I did in a lot of these slides is I will call out when I combined Dallas and Fort Worth into one, DFW. But in a lot of these metrics, I wanted to separate Dallas and Fort Worth. In some respects, they do operate similarly to each other, but I did want to kind of point out the separate things as well. And so you'll see them separated out here. So this particular slide is showing the Dallas demand or absorption for all of 2021. And so again, kind of setting or continuing off of the demand metrics that I discussed, you can see that 2021 was an absolute record year for absorption for market rate multifamily apartments in the Dallas area, eclipsed the previous peak in 2019 by more than 80%. And what we saw was a bulk of that demand came in the second and the third quarter. There was a little seasonality or tapering slightly of the demand in the fourth quarter, but still very strong by normal standards. And very same when we look at Fort Worth, you can see that the previous peak was in 2020, so a different year, but eclipsed that previous peak by more than 85%. So phenomenal demand and absorption within the Fort Worth market as well as the Dallas market. And again, on the back of the in-migration into the Sun Belt area and the continued kind of economic recovery and the household formation that we saw. So kind of to set the table for an occupancy discussion, this was a great slide as well. And here I did combine DFW just to make it a little cleaner, but Econ 101, would say that as supply would increase, that your vacancy would increase as well, as you wouldn't have the strong enough demand on the back end to, absorb that supply. And what we've seen is kind of contrary to Econ 101, and that as we've seen supply increase here in 2014, 15, and into 16, we've seen vacancy slightly decrease or stable off. You see some of the seasonality kind of ups and downs. And then what's interesting is as we've seen supply increase into, in 2020 and into 2021 on kind of the back of the pandemic, with the record level of demand, we've seen that vacancy drop historically. And so it kind of bucks the normal Econ 101 trend that you would normally think of. And it's, again, due to just the different migration patterns. And really, when you look at the household formation, you're getting anywhere from, 2, maybe 3 different graduating classes. And in the early stages of COVID, since it really was right at when you might get one of those graduating classes in 2020, you've now seen a lot of, decoupling almost, where students that were living with their parents, or maybe you had roommate situations, and now you're kind of decoupling into the marketplace. And DFW is a hot market for that. And so when we look at then kind of the inverse of the vacancy or occupancy, and this is Dallas as a whole, I like using this chart because typically you'll see seasonality or seasonal patterns when we go from the third quarter into the fourth quarter and that winter leasing season. And even though the DFW market is not typically, a typical winter location, you still get some of that seasonality. And this was the first time since 2010. So basically since the end of the last cycle, in which we saw the quarter over quarter occupancy change from the third quarter to the fourth quarter be positive since 2010. And you can see even that was kind of just a minor one. You'd have to go back to 2005 to where you saw a much larger increase of 1%. And you see that the typical quarter-over-quarter change is negative 0.4%. And to give some context into these slides, from an overall U.S. perspective, there was a positive quarter-over-quarter change in the U.S. From the third quarter of 2021 to the fourth quarter, and that was the first time that we've seen that on the U.S. level since RealPage began tracking market rate apartments in the early to mid-90s. So just phenomenal performance coming on the back of just absolute record apartment demand in 2021. And we can see kind of very similar story when we take a look at Fort Worth. Again, positive change. Typical change is negative 0.4%, so the same one that we saw in Dallas, and the first time since in 2005. So here it was, right about 1.2%, and we saw that in 2005 in Dallas it was about 1%. So phenomenal performance and kind of bucks the trend of your typical leasing seasonality. And so what did that kind of bucking the trend of the seasonality do is it allowed Dallas and Fort Worth, which I'll get to here in a second, to increase into record occupancy rates at the end of 2021. You can see 97.3%, that huge trajectory upward starting in around the late first quarter and the second quarter of 2021, just continual increase. And to give some context, the U.S. overall rate in Dallas or in December of 2021 was 97.5%. So it was only 20 basis points shy of that particular rate, and an all-time high rate at the end of 2021. And when we break that down by class, I wanted to include this because it's a very interesting story, not only when we look at the 97.3 as a whole, and 330 basis point jump year over year, which is just unreal, considering that we did see some bounce back in demand in the third quarter and fourth quarter of 2020, just from the lockdowns and some of the early stages of COVID. So absolutely phenomenal performance year over year. But then when we look at the demand profile and what that record demand had an appetite for, it was for that luxury product. And depending on the market that you take a look at or some of the submarkets, I would still consider, sometimes that class B, you can have B plus, you could have, some maybe 2010, 2012, 13 vintage product that, in a market like Dallas that has seen lots of construction flip to class B, but it's still very much luxury and at a luxury price point. And so I wanted to point out that, the very strong, almost 97% occupancy, which is a record high in Class A, 97.5, so almost 98% in Class B. And then when you look at the year-over-year numbers, just absolutely phenomenal jumps year over year, and that's on that back of the demand that had an appetite for the luxury product. Still had phenomenal performance in Class C as well, up 3% year over year, and very tight at 97.5%. And Fort Worth, very similar story. We can see a little kind of blip here towards the end, but then increased again in December of 2021, 97%, record high. Again, you can kind of see the history here, and, about 50 basis points shy of what the U.S. Rate was. A very similar story when we break it out by class. You can see, up 2.5% year over year overall. And then when we look at the luxury product, close to 97% in Class A, just shy of 97.5% in Class B, and up 2.5 and almost 3% there. And then this was kind of interesting as well, taking a look at, and these are December numbers, that Class B actually led Class C in occupancy, which is not something that you will typically see in a lot of your major markets. And so the next couple of slides I borrowed from our national deck as well, and I left these in because it lends itself to the overarching discussion of the state of Texas. And so we'll talk a little bit about Austin, Houston, and San Antonio, and then obviously they have a focus on DFW and the demand that we're seeing in those, what we call our major markets that all fall within our top 50 markets. But that demand picture was not always seen in some of your smaller markets. And so your energy-driven markets and your much smaller markets that would fall in our tertiary set within the state of Texas and elsewhere within the country did not see the record levels of demand, and then therefore did not see the record levels of occupancy. And so I wanted to keep this slide in here in case anyone's familiar with these markets, or it's family, travels, and that kind of thing, just to kind of give some context that the demand was driven by a lot of your work from home, work remote. There's a lot of tech companies moving into Austin and Dallas. And so that lends itself to the record demand, but wasn't necessarily seen in all Texas markets. And then another one that I borrowed from our national deck, obviously we've got some focus here in Austin, and I wanted to kind of touch on the fact that Austin, especially over the most recent years, has really been a hotbed for in-migration, companies moving, and then therefore also construction of market rate apartments. And so you always hear about Austin being a very high construction market. And what's interesting is this is taking a look at, we take unoccupied units, so we take the vacancy times the existing units to get to what would be considered the number of units available for rent. Doesn't mean that they are for rent, but that would be available. And so, under 8,000 units available in Austin, considering the market size and considering the amount of construction that's come into Austin, is just a crazy number to think about. It really shows the amount of demand that's seen. No surprise when you take a look at San Diego. Phoenix has been a hotbed of construction lately, so under 10,000 units. Atlanta dipped a little bit in construction. That's why we see this number a little bit higher. But again, contextually, construction is ramping up. And so it's just crazy to think about that there's that small number of units considering the overall size of these markets. And so now getting into some rent growth statistics really quick. What I did on these next couple of slides, again, kept Dallas and Fort Worth separate, and then I have what the combined DFW Metroplex would be. But we can see that, both took a dip, and this is the U.S. average, or comparing the U.S. average, both took a dip in COVID, have been on a consistent rise, and then as of lately, with that increased demand into Dallas, surpassed the U.S. average by almost 3% at the end of 2021, so 16.5%, just phenomenal effective rent growth in the Dallas area. And similar picture when we look at Fort Worth. Fort Worth, the dip wasn't as pronounced in kind of the early parts of COVID. Started that acceleration a little bit quicker than when you compare it to the U.S. average, and then beat the U.S. average by a little bit, 0.3%. In the DFW area was 15.9%. So Dallas gives a little bit more weighting, and so was about 2 percentage points higher than the U.S. And so the operators in Dallas and Fort Worth have had tremendous pricing power on the back of the record demand that we've talked about, and on the fact that when occupancy gets that tight, there's just not that many available units for rent, and so it gives operators pricing power in that regard as well. The next couple of slides will go over the occupancy rate and the forecast, and again, kept them separate. So this is Dallas as a whole. This is the occupancy rate. So you can see ended 2021 at tying kind of a record high that we saw previously to the third quarter. And we will see some moderation in the occupancy rate and some slowing as we head into 2022. But, for most of 2022, still above 96% and even hovering around 97%. So still a phenomenal occupancy number, very healthy occupancy number, and will bode well for the continued construction that we'll get into a little bit later that Dallas will see. And similar story for Fort Worth, except that we're seeing Fort Worth occupancy kind of moderate and stabilize here at, again, in between 96, 97%, closer to 97%. So, phenomenal rise here with the demand in 2021, and we expect, continuing demand to keep that occupancy rate stable over the course of the early of the forecast period. And when we look at effective rent change forecast, you'll see that the dip is a little bit more pronounced. We already started seeing the rent change kind of slow from what we saw in the third quarter. We had always said when we continuously go through our forecast each quarter that we expected the third quarter, maybe that early part of the fourth quarter, when you look at the monthly rents, to be the peak, and then have it start to moderate as we head into the end of 2021 and into 2022. However, when we look at the context of it, even ending 2022 still above 12%, so double-digit rent growth, despite kind of the moderation as that demand, starts to moderate and slow from the record numbers, is still phenomenal performance in the Dallas area. And same thing here for Fort Worth. We've seen it, peak at kind of the tail end, start to see some moderation, but still end 2022 above 10%, and hover around that 12% mark for the bulk of or much of 2022. And again, it's not necessarily that the demand is weakening per se. It's just slowing from record levels that we've seen and stabilizing as we've seen the peaks of the in-migration and that continued household formation. And so now we're going to get into kind of the supply story. So what I've got here is, again, kept Dallas and Fort Worth separate. And here I broke out the multifamily permits and single-family permits. You can see single-family in orange, multifamily in blue. Single-family has continued to rise, did not even see a blip on the radar in 2020. For multifamily, and we've seen this not only in the U.S., but then in a lot of the major markets that we track in our top 50, there was this downward trend as we headed into the early start to COVID. We think that had more to do with, closures of government offices and the ability to pull multifamily permits, maybe a little wait and see. As in the early stages, we were tracking payments data, and there were talks of evictions and all that kind of thing, but it wasn't necessarily due to a slowing in the appetite for multifamily. And we can see that reflected that after that brief dip in 2020, permits began to go back and accelerate into 2021. Still not, to the peaks that we saw in 2015, at least here in Dallas, or even kind of those pre-COVID peaks, but definitely accelerating back up after that brief dip in 2020. And very similar story when we look at Fort Worth. Single family never dipped and has continued to accelerate. Saw that brief dip in 2020 accelerating, but still not above the pre-COVID or pre-pandemic peaks, but definitely on the way there as we'll continue to move through 2022. And in that vein, when I was taking a look at the data, we don't forecast in-house single family or multifamily permits separately. We take a look at the total permit volumes. And so based on the discussion from what I remember from last year, I at least wanted to give some context into the forecast for at least total permit volumes. And again, kept Dallas and Fort Worth separate. And you'll see that here we saw multifamily going up and single family continuing to go up. So total permit volumes continuing to go up. I left this through 2026 to give a larger context from a forecast perspective and kind of a steady rise in both permit volumes, as I think the demand for single family and multifamily will continue to be there over the course of the next 5 years. A very similar story in Fort Worth, continuing to rise, a little bit slower pace, although from a relative size of the market compared to Dallas, you can see that just from the overall permit volumes as well, but a steady increase and continuing to increase as, again, the appetite for both single family and multifamily is there certainly in the DFW area. And when we look at units under construction, it's kind of interesting that even prior to COVID, units under construction had started to slow down from the record levels that we're seeing, and we can see these peaks that we're seeing from 2015 to 2019 slowed significantly in 2020, although some of that could have been due to the early stages of the pandemic, but then we see 2021 coming in kind of around the same number. So still elevated though compared to historical norms, certainly throughout the course of the early part of this cycle, but definitely slowing from the elevated levels that we're seeing a couple of years ago. And very similar story in Fort Worth. We saw again a peak in 2019, some slowing. 2021 was slightly lower, and then 2020 I should say was slightly lower than 2019. And then units under construction in 2021 were slightly lower, but again, well above historical norms when we look back all the way back to the early to mid 90s. But even though that construction or units under construction have slowed, and we don't forecast out units under construction, so kept that to 2021, but when we look at supply or deliveries, we can see that still leads to some slowing per se, or some moderation, but still again elevated, compared to historical levels. So 2022 is slated to be a little bit lower than what we saw in 2021. That was close to the peak saw here in 17, and then an increase into 2023. Some of the units from 21 might have seen some delays into 2022. And depending how 2022 shakes out with, labor shortages and different material shortages, appliance shortages, things like that, we may see some of these units go into 2023 as well. Another thing to note, when we forecast supply, and this is a good time to do this because it works on a calendar year, our very first year forecast is going to be based on actual deliveries. So when we're talking to our clients and we're talking to developers, they're telling us the schedules in which they're going to deliver. And so pretty confident, again, barring delays, in the 2022 number. And when we look at Fort Worth, similarly, supply tapering down from the record levels that we saw in 2021. And then, again, depending on some delays, could see some of the 2022 supply sneak into 2023, but still elevated levels of supply, again, when you look historically. So the units under construction have matched the supply levels as well. And so I know that this is a busy slide. Dallas, I believe, has around 34 different submarkets, but I did want to give some context and break out where we're seeing the construction and where we're seeing the supply. So a couple of things to note: the under construction units is as of the fourth quarter of 2021 to the end of 2021. And I have a little asterisk here. I wanted to give more of context into future supply into this year. So I sorted this in descending order by 2022 forecasted supply. And then I pointed out what we consider the urban core in red. And this just to show that urban core still accounts for a large percentage of the units under construction, but it's definitely slowed from previous levels that we saw a couple of years ago, and has been supplanted by a lot of the higher supply and high demand suburban areas. So we can see Frisco leading, not only in terms of anticipated supply in 2022, but just in overall units under construction. And you can see that there is some correlation between units under construction and the supply number as you head towards the chart as well. And you can see that even some of these top suburban areas are actually increasing in supply from 2021. So you can see, basically doubling here in Frisco. Allen McKinney is actually going down slightly, almost tripling in Grand Prairie and so forth, where you're seeing the urban core actually slowing down slightly in terms of their anticipated supply for 2022. And then did the same thing here in Fort Worth. This chart's a little easier to read. Fort Worth, I believe, has 14 15 or so submarkets, but again, kept the urban core in red, and then sorted by in descending order by 2022 supply. Again, you're seeing some of the larger high supply or higher demand suburban areas leading in terms of not only construction, but then deliveries. You can see the top two here ramping up deliveries in 2022 from what we saw in 2021. And North Fort Worth actually going down slightly, but still receiving, about half of the units under construction in 2022. And then again, similar to what we saw in Dallas, the urban cores are actually slowing down. So in-town Fort Worth is actually slowing down dramatically, with the bulk of the almost 900 units set to deliver in 2023. And you can see the slowing down here in North Arlington as well. And this is a great chart. I actually had done an insights little article on our blogs page referencing Nashville, which actually supplanted Austin. What this is looking at is the percent of inventory under construction. So taking units currently under construction and looking at it as a percent of the overall inventory base. And just crazy construction going on here in Nashville. And essentially what this is saying is that for every 100 existing units in Nashville, about 13 are currently under construction. And I wanted to keep this in here because Austin was the leader. So to give some context to a couple more of the major Texas markets. So you've got about 10 units under construction for every 100 of existing inventory, which is just crazy considering the amount that the inventory has grown here in recent years. And Dallas and Fort Worth still kind of in that upper echelon at about 5 units under construction in each of them for every 100 units that are currently in the existing inventory. So even though construction is starting to slightly taper a little bit, it'll take a little bit for the rising permit volumes to catch up. Those are obviously factored in the later stages of our forecast. So we've got a little bit of a supply reprieve in both the Dallas and the Fort Worth market, but still, leads the nation or leads along with some of these larger top 50 markets in terms of overall construction, which bodes well for the continuing demand that we anticipate seeing into the area. And that goes to show that when we take a look at expected overall deliveries in the calendar year of 2022, no surprise here that DFW leads. I do have a chart next that will break this out, but to give some context, I believe, let me look at my notes here real quick. Dallas, if you break up this DFW number, Dallas is the bulk of it at 17,000 units, or roughly 17,000. Fort Worth, about 7,000 units, so around 24,000. Leads other areas like Phoenix and some of your other gateway. Still have Austin here. We've talked about all the construction in Austin still kind of in this tier 1 bucket here, as well as Houston. Houston continuing to be in the top in terms of overall deliveries and construction volumes within the nation. And so here wanted to show that as well. I believe I did this chart last year where it kept the DFW Metroplex up at the top to give some context into that, then broke out each of the markets. So it was right about 17,000 and roughly about 6,000 for 2022. And then you can see the amount, increase in supply in Austin, Houston going up slightly, and then San Antonio staying roughly the same, much smaller market when compared with the size of Dallas and Fort Worth, Austin, and Houston. But you can see kind of the supply increase. And then I kept annual rent change and occupancy on here. Just phenomenal performance across the board in your top major, Texas markets. And you can see just in terms of the occupancy levels that we're seeing, this is going to be an annual average for 2021 and 2022. And we talked about the forecast where it'll slightly taper, but still maintain some very record levels of occupancy. And so, the supply will be, needed to give people options when they're looking at, market rate multifamily units. And that is what I've got on kind of the DFW area. I do have, like I said, about 9 or 10 slides that go through permits, supply and or units under construction and deliveries for Austin, Houston, and San Antonio, if we wanted to go through those. Otherwise, they are included in the slide deck, and so you guys can take a look at them at your leisure. Did we want to get to questions, or did we want to take a look at those slides?
I think I would go ahead and roll through the slides if you don't mind.
Sure. So with these, I did, there'll be 3 slides for Austin, 3 for Houston, and 3 for San Antonio, kind of keep it easier to keep everything in check. But so very similar here to what I did with Dallas and Fort Worth. Again, we only forecast total permit volumes. So interesting to see here, the permit volumes, at least as of what we're tracking and forecasting now, actually peaked in 2021, slightly set to kind of go down towards the end of 2021 and then moderate, but still at a very elevated level compared with historical norms, and still well above the peak seen here before the great financial crash and kind of the housing bubble that happened in that 07, 08 timeframe. And you can see then what that's done for units under construction. We've talked about Austin, and obviously when we looked at some of the national charts was, up there from a national level in terms of construction, just that ramp up, kind of even starting, I would say, in 2012, the early part of the cycle, kind of maintained, around 15,000 units under construction, and then ramped up in 2019. We saw that ramp up as well in Dallas and Fort Worth. That's really when you started to see a lot of the demand and the construction for market rate multifamily apartments in a lot of the Texas areas. And when the appetite for apartments in the Sun Belt region actually started happening. And so that narrative has been there even prior to COVID. COVID, I think, just accelerated a lot of that demand into the Sun Belt. But you can see that units under construction, just shy of 30,000 in Austin. So just an absolute huge number. Again, when you consider the overall size of Austin and how much it's grown over the course of the last couple of years. And you can see that from a supply perspective, again, elevated ever since construction started ramping up in 2012, hit the peak in 2021. And you can see we have 2022 hitting well above that peak, with just about 12,000 units in 21, and it's going to be a little over 18,000. Again, even if we saw some delays go into this 2023 number, we can anticipate supply being elevated at least for the course of the next couple of years in Austin, as this is already incorporating projects that have already broken ground. So when we look at Houston, kind of similar story. The trajectory is not as, obviously we saw it kind of moderating or stabilizing from a permit volume in Austin. We can see this, still elevating. This kind of mirrors what we saw in Fort Worth. It's not as accelerated as what we saw in Dallas, but again, continuing to increase, as I've said, the demand and appetite for single family and multifamily will continue to be there. So no surprise to see that continue to accelerate. And Houston is an interesting market. It definitely has more volatility and more movement, obviously tied to the energy sector. There was Hurricane Harvey that we saw in, I believe that was 2018, I want to say. And so, definitely tends to be a little bit more volatile in terms of units under construction, and follows the energy waves and the different migration patterns that happen because of that. And we can see that, 2015 saw the peak, 19 was still relatively high, and we've seen the units under construction taper a little bit. However, when we look at new supply, and we saw Houston, when we looked at the national chart that had a different bucket, Houston was still in that top tier bucket in terms of 2022 deliveries. And we can see that reflected here, that, you know, almost 18,000 units, still at the current kind of elevated level that we've seen since 2020, and continuing to be so as we look into 2023 as well. But again, we can see even that volatility in supply that we saw in the units under construction as well. And really, we even saw that here in some of the permit volumes, just more volatility than what's seen in most major markets. And finally, San Antonio, much smaller market when compared to those two markets, but you know, saw a similar trajectory actually to Austin, where we saw a peak and then a little bit of tapering towards the end of 2021. But the tapering was kind of short-lived, as we're seeing it moderate as we head into the early years, and then kind of accelerate a little slightly into the latter years. Again, this is total permit volumes, so this would include both. And we've seen units under construction slow slightly since you know, their peaks here in these middle 15 to 17 years. But again, as I've said, you know, with the other Texas markets, still well above historical norms that we're seeing kind of in the early stages of this cycle, and still kind of at an elevated stage even at the end of 2021, slightly lower than what we saw in 2020. And we see that reflected in the supply numbers. The supply is actually kind of stabilizing and moderating at kind of that current level. Slight increase into 2023, and again, talked about, you know, if we do see some of the delays from whether it's a labor perspective or a materials perspective, you could see some of those kind of sneak into 2023, but still maintaining, you know, solid levels of supply that we've seen over the course of the last couple of years, but lower than a peak seen in 2017. And that is it. Any questions on anything that was covered today, whether it be anything from the DFW Metroplex to Austin, Houston, or San Antonio?
Yeah, thanks, Dan. Just monitoring the Q&A box while you were presenting there, and thank you for your overview. Thanks for walking through with some really, really good data. First question that had come through that I wanted to make sure we just verified before everyone hops off. We will share the deck that Dan presented today. So if you have any questions, feel free to reach out to us afterwards. I do see a question here, a good question that unfortunately we don't have much data on. Any data on costs, construction costs per unit, how those costs have risen. That's a really good question, and I wish we had that data. And if anybody in the crowd has some insight onto that data, then we'd love to talk a little bit further, because that's a question that, candidly speaking, our team has been getting a lot more lately, and I think it stands to reason. You know, even as simple as something as going to Home Depot for a little weekend project, and you see the cost of a 2x4 2 years ago. You look at it now, and it just the sticker shock is just incredible. So any of the details, and Dan, feel free to not hijack your presentation here, but any of the details I can share would be purely anecdotal, but I can tell you that anecdotally, we have been hearing of rising construction costs, both on the hard side, just from physical labor, physical product, whether it's wood, whether it's the actual distribution of getting some of these things on site. Now, some of the early part of the pandemic, construction costs weren't really impacting the bottom line just yet, because a lot of those purchase prices on a lot of the goods were already agreed upon well in advance. It's really now that we're starting to see some of those prices increase and impact that bottom line. So the hard costs certainly gone up, but also the soft side, the labor costs, that's something where we've seen some more strain too. To that point, I will mention though that we had met with a group, locally a couple years ago, and they were, I think this was even 2017, 2018, they were already talking about how tough it was to get labor on site. They were talking about they were losing on-site labor to deals down the street where workers were getting, an extra $1 an hour. I don't remember what the exact number was, but enough that it was actually delaying their project because labor was already so tight then. And I think over the past year, we've only seen that trend exacerbate. Now, how much longer that continues, I think that's going to be kind of the art in figuring out some of these construction costs. But nevertheless, long-winded answer, we've seen those construction costs go up. Unfortunately, I don't have like a clean cost per unit data point to share there. One other last thought on that too is something we have been seeing. It kind of ties into construction, kind of ties into property acquisitions, but we've actually seen that acquisition costs have got so steep, and especially some of the suburban areas, that historically, if you were looking at acquiring, let's say a 1980s, early 1990s product that was built in Hearst or was built in Richardson, rather than doing a new development, those cap rates have compressed tight enough now that it's actually incentivizing people building out in the exurbs. And I can tell you anecdotally again that I live in the northern part of McKinney, and even driving out east on 380, you're seeing quality apartment products, maybe not luxury a la downtown or, Legacy West, but you're seeing quality 200, 300, 400 unit properties getting built in Princeton and Farmersville. And, if you go west, even up into Prosper, and, it's incredible to see the environment today. But anyway, again, Dan, I kind of hijacked your presentation there, but it's a good question, and I wanted to touch on it because it's something that we've been getting asked a lot lately.
Yeah, and we don't have the price per unit, like you said. Anecdotally, I still, so when I was on the account management side, I covered our REIT clients, so the publicly traded REITs, the 7 major ones, and then there's another handful of smaller ones. And I still attend all their REIT earnings calls, which actually start later this week. And anecdotally, they've talked about roughly about 10% is what they're kind of seeing in terms of labor costs and materials costs and things like that. The big one, and I know Jay Parsons, our chief economist, had done kind of a rundown of the top 10 takeaways from the earnings calls. And one of them was that not only, I think he stated at 10%, but a lot of it was being seen on appliances, and appliances almost more than your lumber or some of your other things were where they were getting hit. And I've kind of seen that where I live in an apartment in a brand new apartment in the suburbs of Chicago, and I was on one floor, transferred to a higher floor, and we know that they, give floors, each, and it's the same series of appliances, but the appliances are slightly different. So you could tell that maybe there was, a supply chain issue. I mean, it also could have corresponded with when they changed over and redesigned the appliances or whatever, but just some kind of anecdotal evidence that, that is kind of a thing. So your fridges, your washer and dryer, your dishwashers and things like that. So roughly about 10% is what they were kind of stating. And to Carl's point, that even despite that 10%, that a lot of times some of these development deals, especially if you're with a REIT and you have your own in-house development, and so you know how to do it, you know how to manage risk, that those deals are penciling out with higher yield than stabilized or even value add acquisitions. So.
Yeah, really good insight. Thanks, Dan. And thank y'all for the questions. And I'm sure some of what we're saying is preaching to the choir here about rising construction costs, but it's good to hear from the applied perspective, from y'all's boots on the ground perspective. So we appreciate y'all sharing, and we'll follow up with any questions that maybe come through. But Kenny, I don't know if we've got any other questions that you've seen, or if you want to take it from here.
Yeah, I've seen a couple comments in the chat room, I guess. I know that Blake Pierce mentions that Providence did about $2.3 billion in pre-construction in 2021. He also goes on to mention that in 2021, he felt like there was an increase of about 16%, if that helps anybody.
Yeah, that's really helpful. And I saw Blake has one more question here regarding forecasts, looking at any expected decrease in demand. And I would say that if you look at real estate holistically within the economy, there's never been a real estate slowdown that's been separate of an economic slowdown. Now, we've had economic slowdowns that have been generated as a result of real estate issues. But I think if you just look at the drivers of demand that Dan did a really good job covering here, you've got a lot of people moving to DFW. I want to say even pre-COVID, it was something like 110,000 people per year moving into DFW. Here's a good chart on that. That's like that's basically Austin moving to Dallas every 8 years, like just to give you a sense of scale of how many people are moving into DFW. And Austin and San Antonio and Houston, it's the same thing, just to different varying degrees. So I don't think that demand will slow down too much. I think if maybe there's a wild card, it's just how much of demand that would have historically been targeted towards apartment, how much of that goes to the single family build for rent. And I think that's going to be something that's really, really compelling to watch over the next 10 years. We don't currently have an answer yet because it is still so new, but it's going to be really fascinating to watch.
Yeah, I would agree. Very good presentation, guys. I know I enjoyed it, and based on the comments, I think others did as well. I think it's clear that without demand, there's so many issues we're fighting right now in the industry. To your point, whether it be price increases or just flat supply chain issues, and not being able to get the material we need. Without demand, it's all for naught. So it's exciting to see that at least for the near future, it still looks good.
Absolutely.
Okay, I believe this concludes the webinar for today. Once again, I do appreciate Dan and Carl. We all appreciate your time and information you bring. I'm interested to look at the slide deck, print it out, and spend some time with it, and very good information. So, having said that, once again, I want to thank our webinar partner, Trinsic Residential Builders, and thank you to all of the attendees. Do appreciate the questions and the feedback as well. So I believe until next time, everybody have a good week.